Welcome back to FTfm. For the past 20 years, JPMorgan Asset Management has published its long-term capital markets assumptions annually. Many investors and consultants rely on this set of figures to base their investment strategies. So joining me to discuss this year's outlook is Mike O'Brien, Global Co-Head of Solutions and CEO of JPMorgan Asset Management in Europe, the Middle East and Africa. Welcome, Mike.
Morning.
This long-term capital markets outlook, it's a fairly bleak picture that you've painted.
Yeah, yes. I mean, it is looking 10 to 15 years out, and you're right. It does present a picture of low growth, pedestrian returns from asset classes, but a lot lower than we've seen historically, both on the economic and on the capital market side. Mm-hmm.
And inflation to rise from current levels, but not by much?
Yeah, our view on inflation is that the inflation rates generally would be in line with where the central bank set policy. Mm-hmm. So, for example, right now we do know that as pension funds in the UK are looking to hedge inflation, that the expectations are higher than what policy rates will be. But our view on inflation will be in line with policy rates set by central banks.
So relatively low.
Relatively low, yeah.
One interesting piece of research within the publication was on returns to private equity, an asset class that's been increasingly popular in recent years. But you find that average alpha is being eroded. It's no longer an asset class where you can rely on there being outperformance.
Yeah, I think the return on private equity will move from sort of getting return from just holding private equity from an intrinsic and a liquid point of view. I think there will be much more focus on the ability of asset managers to actually work through their opportunities to deliver returns. So less return, intrinsic return for holding the asset class and for liquidity, and more for the work that the manager puts into the private equity program.
Mm-hmm. And then that becomes a challenge for investors to select the right manager, presumably.
Critical. I mean, if you think of it, the expectation from private equity as an asset class, our expectations are about 8 to 8.5%. But you can get that up to double that if you pick the right manager. So the critical point is having the right strategy in terms of the type of private equity and two, the manager you choose.
Mm-hmm. And the one ray of light in the report is that there may be some hope for pension funds at last, pension funds with deficits.
Yeah. Well, if you think of it, the conclusion from the study is that we will have lower pedestrian rates of return from risk assets, lower than we've had historically. And as an example, the real return from equities in our study is going forward would be looking at maybe 4.75%. That's 2 percentage points less than what we've had historically. But as you know, with pension funds, there's also the challenge about sort of moving from risk assets into risk hedging assets. And our view is that risk assets will outperform risk hedging assets by a considerable margin. And our views on equities would be a 4% risk premium, for example. Credit on the investment grade would be 1.25%, and high yield, it could be anything up to 4% of a premium from holding credit and equities versus the long-term bonds that pension funds are moving towards holding.
And so the current trend for pension funds to de-risk at various costs, is that misplaced?
Our view is have a plan. The urgency is not there in our view. I think over the course of the next 10 years, that a program that is predominated with holding equities and risk assets will outperform long bonds by up to 5% per annum. Mm-hmm. So again, it is about having a sort of a glide path, a progressive program, getting from risk assets into risk hedging assets, but time is on your side.
Mike O'Brien, thank you very much.
My pleasure.
For more on this topic, please go to ft.com/FTfm.